So in this video, as I said, we're going to discuss about an argument which keeps coming again and again, which is, should I buy or should I be renting? We'll also look at some of the schemes which are available to first-time home buyers, and also some tips and strategies uh, to figure out the down payment or arrange the down payment. This is one of the biggest stumbling blocks that many of the prospective home buyers encounter. So we'll talk about it and try to give you some suggestions about that. Okay, before we get started, my name is Neil Joseph. I'm a mortgage agent licensed to operate in the province of Ontario, Canada. I have a range of finance mortgages, tens of millions of mortgages, not hundreds yet, but tens of millions of mortgages for first-time home buyers, real estate investors, or regular home owners who want to refinance or transfer their mortgage. So whatever I'm going to tell today is from my experience. I hope you find this useful. Okay, so let's start with the first aspect of the first topic, which is, should you be buying or should you be renting? Well, some of the arguments that you would hear against buying is, one, it's always cheaper to rent an apartment or a property in big cities like Toronto or Vancouver, as the properties tend to be a bit pricier. So obviously rents are cheaper, and some people suggest that continuing to rent is a better option rather than going out and buying a property for yourself. So we'll evaluate that a bit. Some of the other arguments against buying is you would get more returns by investing the same amount of money in a stock market, or that the homes properties tend to be high maintenance and that you have too much of commitment that you sort of commit to when buying a home. Some of the counter arguments are obviously, well, don't rent because you're going to help the landlord pay off the mortgage, right? Most of the property buyers in big cities like Toronto or Vancouver, when they are buying properties to invest in, they are not necessarily trying to make an income from renting. What they are trying to gain off is the increase in value that the properties tend to see over a period of time. So these are not cash flowing properties, so rents tend to be low, but the investors or the owners are trying to gain from an increase in the value. So basically you gain out of the capital gains that comes from holding onto property while the tenant pays off the mortgage, or at least keeps the cash flow slightly negative to neutral. The other aspect is that people don't talk about when it comes to the returns on stock market is the difference in leverage that you have with respect to investing in stock market vis-a-vis buying a home. So we'll investigate the leverage aspect of it in one of the subsequent slides in this video. So again, I don't think we're going to conclude on which of these arguments trumps, but I can present some views and some pointers as to why it makes sense to buy on property rather than rent it. So let's dig a bit further into the leverage aspect. So what is leverage? Leverage is nothing but how much is the money working for you, right? So for example, let's take an example where you're investing $50,000 in a stock market. So basically, you're going out and buying $50,000 worth of stocks or shares in a company, and which are listed on a stock exchange. Versus you're putting in $50,000 on down payment to buy a house which is worth $750,000. So we're assuming that's an insured mortgage, so you're paying less than 20% down, and $50,000 is the minimum down payment that you need to buy a house for $750,000. Okay, so now let's see as to what happens if there is a 1% or an equivalent increase in the value of the asset that you're buying. So suppose the stocks that you're buying increase by 5% over a period of a year, right? And we'll assume that the house that you buy for $750,000 is also increasing by 5% in a year. So what happens? Now, given that the leverage, which is you're buying a 50,000 home, or you're buying a 750,000 home by only putting in 50,000 as down payment. So essentially, you are getting control over an asset, which is 15 times. That is 750 divided by 50 which is 15 times the value or the money that you are investing in. So it's 15 times, right? So for an equivalent gain in the value of the stock and the home, in this example, say 5%, the return that you get from the house is 15 times the return that you would get on the same money invested in the stock market, right? Now, this is, of course, before adjusting for mortgage payments. But if you consider the mortgage payments which go out, you are still left with 5 times more returns, dollar for dollar, that you put in a house rather than in the stock market. Now, you could say that the returns on a stock market tend to be a bit higher. Well, of course, the risk is more. But generally, you would say that the increase in the property prices is slow but steady, and it's an asset that doesn't really lose value. Can't say that for really much for a stock, right? So this is one aspect which people who argue in favor of stock do not really talk about, the leverage aspect. The only way that you can increase your leverage in a stock market is by buying a margin or by trading in derivatives like options. But again, those tend to be very, very high risk strategies because one, the assets lose value over time. So unless the market moves in your favor, you would end up losing money rather than gaining anything else. So leverage, which works in your favor over a long-term asset like a house, is much more favorable than what you get in a stock market. Hope this concludes this aspect. Okay, now let's go ahead and look at some of the incentives which are available to first-time home buyers. And first up is the federal first-time home buyer incentive. So what is this all about? This is a scheme offered by the federal government wherein Canadian government will invest 5% or give you 5% or 10% of the home's purchase price as down payment. So this is in addition to the down payment that you would obviously have. So minimum of 5% from your end, and the government will pitch in with 5% or 10% depending on the transaction that you are going through. If it's an existing home, then the government gives you 5%. If you're buying a new home, then they can give you up to 10% of the value of the purchase price as down payment. Obviously, when they are giving you that 5% to 10% as down payment, they are going to retain that 5 to 10% equity or interest in your home, which essentially means that the government will become a part owner of the property to that extent. Well, this obviously helps to lower your mortgage carrying cost and not necessarily your mortgage eligibility. So basically, it just helps reduce the mortgage payments that you have to make over the period of the course of the mortgage. Right now, there is good news for first-time home buyers in big cities like Toronto, Vancouver, and Victoria, CMA, because come 3rd of March to 2021, residents or people who are buying the first property in these regions will be eligible to get their income qualified to the extent of 150,000 instead of the earlier 120,000. And also the borrowing limit has been increased to 4.5 times instead of the earlier 5 times the qualifying income. So as I said, this is going to help you reduce the mortgage payment outgo on a monthly basis, but not really help towards increasing your mortgage eligibility. All right. So my analysis shows that it doesn't really help people who are drawing an income of about say 150,000 and buying a property without any condo fees, because typically they would be able to borrow more than 4.5 times their income. And it's probably more required in big cities like Toronto and Vancouver, where prices tend to be pricier. So do your own analysis as to whether this makes sense to you. You can find more details at the link which is being given at the bottom of the page. I'll also be placing this URL in the description of the video so that you can get it more easily. Okay, so this was the first scheme. The second is the home buyer's tax credit, and this is a tax scheme which is required by CRA, which essentially reduces your total taxable income in the year that you purchase a home by about $5,000. This could translate to a maximum tax reduction of about $750. Again, this is for both the couples or the partners involved if there is more than one buyer. And you would qualify for this if you or your partner are acquiring, of course, a qualifying home, and also you've not lived in another home owned by you or your partner in the last 4 preceding years. Now, this is a very, I would say, a very lenient view or definition of what a first-time home buyer is from a taxation standpoint. Some of the other schemes have a much more stringent evaluation as to who is a first-time home buyer. So don't think that if you qualify for one scheme, you qualify for all the schemes which I mentioned here. Some of the schemes are very, very stringent, and we'll talk about that in some of the subsequent slides. Again, the link to this, you can find more details at the link which is mentioned at the bottom of the screen. I'll be pasting this in the description of the video so that you have easier access to it. Third up is the RRSP home buyers plan. So essentially, this plan allows you to borrow or withdraw funds from your registered retirement savings plan so that you can buy or build a qualifying home for yourself. This essentially is a borrowing from your RRSP, and you have to repay these funds over a 15-year period, which is long enough. And in case you do not do that starting the second year from when you borrow, there would be a tax clawback which would happen over the period of time. So yeah, this is a very, very favorable scheme. So make sure that you use this if you're buying your first home and you have sufficient room in your RRSP. Doesn't matter whether you have already accumulated so much funds. We'll talk about another way as to where you could still make use of this as long as you have room in your RRSP to withdraw. Again, this scheme provides the ability for you to withdraw up to $35,000 for each borrower. So if you and your partner both are buying a property, then combined you could borrow up to $70,000, so $35,000 each from your RRSP. Again, money could be spread across different RRSPs accounts as long as they all belong to you. So you'd be able to withdraw money from these accounts without having to pay any tax on it. So you get to withdraw from the RRSP if you're a first-time home buyer up to the extent of $35,000 each. Now, as I mentioned before, in case you do not have so much saved up in your RRSP, you can still take an RRSP loan from various institutions so that you can put money into your RRSP and then take it out to the extent of $35,000 to put towards down payment or closing costs or any other costs associated with buying your first home, right? So you can reach out to me to get more details about how the RRSP loans, and I'll be more than happy to share that with you. Again, further details in terms of what the home buyers plan looks like is provided the link at the bottom of the screen. Again, this link would be provided so they can easily access it and get more details for yourself. Okay. Next up is land transfer tax. Again, this is unique to different geographies. So I'm talking specifically about Ontario and Toronto in this section of the video. Similar schemes would apply probably to your region as well. So you can investigate about that. So basically in Ontario, if you're buying a land or an interest in land, you have to pay land transfer tax. First-time home buyers are eligible for a refund on all or a part of the scheme. This has, however, a much more stringent view in terms of what qualifies as a first-time home buyer. Basic criteria is, of course, you have to be 18 years old, so you are an adult or major, and you should not have owned a home or an interest in a home anywhere in the world, and your spouse cannot have owned a home or interest in a home anywhere in the world while he or she was your spouse. So again, I'll repeat, if you or your partner has ever owned a home anywhere in the world or had an interest in a home anywhere in the world, then you are not eligible for the scheme. Again, as I said, this is a much more stringent view in terms of how Ontario and Toronto, the city of Toronto, look at first-time home buyers. Make sure that you really evaluate and see if it is applicable to you. Okay, if you qualify for the scheme, you can you can get a refund of a maximum of $4,000 if you buy a property in the city, in the province of Ontario. A similar refund amount is available if you're buying within the city of Toronto. But again, remember that if you're buying the city of Toronto, then 2 land transfer taxes are applicable. One is for the from the city of Toronto. The other is from the province of Ontario. So double the taxes, but double the refund. If you're buying elsewhere, then only one land transfer tax. But again, you could get up to $4,000 refund on the tax. Okay, next step is GST or HST on a new housing rebate. Now, this is not a scheme which is restricted to first-time home buyers, but this is available to all everybody who is buying a home for themselves, so owner occupancy. There is a different related scheme available for people who are buying it as a rental investment as well. But we're going to talk specifically about what is available to home owners. So if you are building or you have engaged somebody else to build a house on land that you own or at least, or you make substantial changes to a house that you already own, convert this non-residential property into your home, then you can claim HST or GST rebate on the inputs that go into your home. So basically, the government charges HST or GST on material which is used to build a home, and this is one scheme to get a refund out of that or a rebate out of that. Now, check with your builder if you're buying a new construction property as to the whether the purchase price which is being quoted to you already factors in for this rebate. Otherwise, you should inquire as to how you can get access to this rebate. Generally, the builders will price in the rebate for you so that you don't have to pay HST or GST, which is otherwise applicable if you're buying an investment property. Okay, so have that conversation with the builder to understand how is the purchase structured. Okay, I think so. This is these were the various schemes that I wanted to talk about today in terms of what is available to you to as a first-time home buyer, or that in the last case, if you're buying a property for your occupancy. Now, in this section, we are going to discuss about how are you going to arrange for the down payment, because down payment is one of the critical requirements for buying a house, and this tends to be one of the stumbling blocks that many people encounter or spend a lot of time trying to figure out and come up with a down payment for the purchase. Okay. First up, if you are trying in the process of buying a home or thinking of buying a home, then I would strongly advise against taking up a car loan if you have not taken one already, and it might be best suited if you can eliminate a car loan if one is already existing. For every dollar of car loan that you have, you in fact end up losing many more dollars in terms of your eligibility. Okay, I will publish a link to a blog that I have written something back in terms of what is the actual impact that a car loan has on your mortgage eligibility. You will find that in the description of the video. If you have a student loan, hopefully you are getting a high enough income to offset the student loan that you had taken to complete your education. And my advice would be to pay off your student loan if it is nearer to completion, so that it opens up some more room for your mortgage eligibility. If it is if there is significant outstanding home loan, or if the repayment period is too long, then maybe you can retain it, but that would be my advice. Okay, and again, I strongly advise against assuming any other additional debt other than a mortgage if you are in the process of buying a home, because it has serious impact on how much you will be eligible for. Okay, so try to avoid a car loan, pay off your student loan if possible, and do not assume any additional loan, right? Because this essentially saves up much more room in your income to save towards the down payment. Okay, that's one. The second is, do not have an unrealistic target in terms of how much down payment you want before you would buy the house. The minimum down payment that you would need is 5% if you're looking to buy a property less than $1 million, if your income qualifies, to the extent that your income qualifies. So do not feel compelled to save that 20% down payment to avoid the CMHC insurance or the mortgage insurance, or so that you're keeping your mortgage payments lower or under a desired limit, right? Look at your budget, but again, do not spend years trying to build a significant down payment, because in a competitive market like Toronto or Vancouver or any other big cities which are growing, it's just not just Canadians, but foreigners as well who are competing to buy homes, right? The longer you wait, you will get priced out of the market. So if you're early looking to buy a detached home, maybe you'd have to settle for a townhouse or a condo apartment. And basically you come down the ladder rather than going up the ladder, as well as the competitive market is concerned. Okay. Next up, if your parents are in Canada and they are suitably settled, they have a regular income or a pension coming, I would suggest that you talk to them about getting you some assistance with respect to the down payment. It could be in the form of an early inheritance. It could be in the form of a non-refund, not repayable gift. So see if they can help you with coming up with part of the down payment. So suggestion is seek help from the bank of mom and dad, right? Now, in case they already have a home, which they have significant equity in, they could pull money out of it by means of a refinance or by means of a reverse mortgage. All these schemes are available so that they can come up with the money that you would need to put towards your down payment. So seek help if your parents are able to help you out. The next step is everybody probably wants to buy a home on their own, but it tends to help if you have a partner with you. Now, the partners could be your siblings, your better half, your friends, but see if you can partner up with anybody and get the first home purchase. Even if you don't have a significant other partner, see, as I said, you can look at options where you can buy with a sibling if you get along, or close friends if you think that you could manage an investment together, right? This again helps you get onto the property ladder while you're still building up your own income, your career, and maybe a higher down payment for a bigger purchase subsequently. But buying a home helps you build equity so that your subsequent long-term home can be an easier purchase. Okay, so this could be a very good short-term strategy for you to get onto the ladder while you're trying to establish yourself and get the desired property at a later point in time. Okay, this may not be very, very popular suggestion, but in case you're staying with your parents, maybe you can look at prolonging that stay for a bit longer, and maybe invest in a startup home while you continue to stay at your parents' home. So this might help you start with a maybe not so desirable property, like maybe you could buy a condo apartment and then let that grow in value so that your equity increases, and you could look at selling that property off in a couple of years' time before you buy your own larger, bigger, more desirable property if you wish so. So again, this could be a very short-term approach wherein you continue to stay at your home with maybe lesser contribution in terms of rent or living expenses, whatnot, and divert most of your income and energy towards investing in a startup home. Now, obviously, this comes with the requirement that you put 20% down, but maybe 20% down on a condo apartment is easier than a 20% down on a detached home or a 5% down on a detached home. So choose how you want to approach it, but this is again good strategy for you to get into the property market. Over the years, I've come across many investor clients who have had multiple properties, or they bought multiple properties while they continue to stay at their parents' home. So it helps build wealth over time. And at some point, when you think you're settled enough, you could look at selling one of those properties or all those properties and then buying a owner-occupied property for yourself and moving out of your parents' home. But again, as I said, this could be a very short-term good strategy. One of the other things that you will look for doing is while you're trying to save up the down payment for the next purchase or the upcoming your first home, you could reduce your rental expenses, which seem to be one of the biggest expense heads, which is rent. So try, maybe investigate trying with staying with your friends, or having a roommate, or taking a smaller or cheaper accommodation for yourself while you're saving up your down payment. It could again be a short-term gain for a long-term or a long-term gain. Okay. The last step is, in case you're not able to save up money, you feel that you're spending everything that comes into your spending account, then what you could do is you could work out an arrangement with your employer wherein a portion of your pay or salary gets diverted into a savings account or some sort of a restricted account before it hits your spending account. Again, RRSP could be a very good solution in this case. Make sure that you maximize your TFSA RRSP contributions so that much of the money goes into those accounts directly from your pay before the rest hits your spending account. This could be a very good approach towards having a forced saving, and it would help to build the down payment. This is extremely useful if you are one of those people who would spend money if it is available to you. Again, one of the other approaches that you would use is not carry your credit cards or debit cards along with you. Try to buy stuff in cash so that you know how much you're spending and you will keep track of it more easily. Okay. So with this, we have come to the conclusion of this video. Again, many more such resources are available if you follow me on my YouTube channel or Facebook page, or you can reach out to me for any consultation that you want.